The Great Deceleration, a market correction. Whatever you call it, many are feeling a very real shift in the market. A slowdown from the furious pace we experienced in 2021. But what can we expect in the near future? I'm Lindsay Gordon, and this is Title Talks, the show where we invite you to spend some time with the most influential people in title. We have a special episode today. For our weekly news podcast, 4 Stories, host and my colleague Jordan Norris interviewed Nadia Evangelou, senior economist and director of forecasting for the National Association of Realtors. They talked about projections for the housing market and what lies ahead for homebuyer affordability. We only had time for a short excerpt from that conversation on 4 Stories, so today we're sharing that full interview with you. It's important to note that although recorded just 2 weeks ago, there is no crystal ball to foretell the future of the market, and numbers can change. Here's Jordan with that interview.
Nadia, welcome to 4 Stories.
Hi, Jordan. Thank you for having me here today.
So excited to have you. Nadia, is this the craziest market you've ever forecasted for or been through?
Actually, since 2020, and specifically after May 2020, the era of COVID-19, the world of real estate has seen a massive shift. The US housing market was unpredictable, to say the least, during 2021. Sellers received multiple offers on their houses as soon as they were listed, and their houses ended up in the middle of bidding wars with multiple buyers, and sellers often close at double-digit percentages over initial asking prices. So 2021 was the best year in the last 15 years. Since 2006, home purchase rose in an abnormal way, although home prices were rising, eroding affordability. And we expected that, but not at the pace that we at the level that we saw that. So the main reason is due to low mortgage rates. Mortgage rates were very low, reaching record lows. So many buyers wanted to benefit from these low mortgage rates. In the meantime, inventory also reached record lows. Thus, low inventory and mortgage rates resulted to multiple offers. As for now, the market is becoming relatively more normal, and this is what we want to see, and more normal, more predictable, healthier real estate market. Mortgage rates have dramatically increased since the beginning of the year, about 2.5 percentage points. Thus, due to higher mortgage rates, we actually expecting now to see a slowdown in the housing market. And this is what we see already. Home sales have dropped for the last 4 months. So this is something we expected, and we also expect to continue to have this drop in home buying activity.
Yeah, it's been an absolute wild ride the past couple of years, especially myself being someone who bought during that right before it got too crazy. So I'm lucky in that sense. But right now,
I feel lucky as well. I bought my house in 2018, so I feel very lucky.
Yeah, very, very lucky. Right now, affordability is on many people's minds, especially first-time home buyers. What would you consider to be the critical factors in shifting the market in those buyers' favor?
Indeed, compared to the beginning of the year, buyers need to spend about $800 extra every month for the median price home. So in areas with very expensive areas, it exceeds $1,500 or more. So as a result, the qualifying income for the median price home has increased to above $100,000 from $70,000. So while the reason then is said income requirement to buy a home, the qualifying income shows how much money someone needs to earn if he wants to spend for principal and interest about 25% of the income. And what we see is that many buyers no longer earn the qualifying income for the median price home, so they're out of the market. So when inventory, to answer the question, so when inventory is low and demand is high, we have a seller's market. And when demand is low, and inventory is high, we have a buyer's market. What we need to have in order to shift the market is like more homes to be available like for sale. And actually, this is what's happening. This is what we see. Like since the beginning of the year, inventory has increased about like 35%. While it's typical to have like more inventory in the spring and summer months, inventory is rising faster than the average level, the historical level. And according to our data, it shows that inventory, for example, rose 25% during April and May, compared to 8%, which is like the pre-pandemic average level growth for the same time frame. However, we should also have in mind that we are still missing many homes. And to give you an idea, in a balanced market, we need to have about like 2 million homes available for sale. However, we currently have just a little over 1 million. So although inventory is rising, it's still low. So this is what we have to have in mind.
Yeah. And and it is definitely rising. In one of the more recent articles that we read in May, inventory rose between 16 and 18%, which seemed to be some record that was set year over year, from last year to this year. So it's good to see that. And that's a really good point. Right now, we're also seeing record high prices. You kind of spoke about that a little bit. And obviously, the Fed continues to raise interest rates in order to combat the rising inflation, including the housing market. But specifically in the housing market, when should people start seeing costs start coming down as a result of those rates?
Yeah. So unfortunately, we expect like affordability to decline even further, like in the following months, like both like home prices and mortgage rates will continue to rise, increasing the home buying cost. However, there is a bright side in the story. So the good news is that we expect both prices, home prices and rates to rise at a slower pace. First of all, the Fed will take more rate hikes in order to slow inflation. Although the Fed already raised its short-term interest rates 3 times, inflation still runs at 40-year high. And we have mentioned like multiple times, that it will take several months for the Fed to slow inflation. And of course, the war in Ukraine doesn't help. Like it makes Fed's mission like even more difficult. So as the Fed will raise interest rates in the following months, mortgage rates will also increase. However, it seems that the upcoming rate hikes will likely have a smaller impact on mortgage rates. And like, for example, when the Federal Reserve rates its short-term interest rates, like in March, by 25 basis points, mortgage rates surged about like 80 basis points in the next like following 3 weeks. As a result, the 30-year fixed mortgage rate like rose to about like 3.9, from 3.9 to 4.7% like by the end of March. However, when the Federal Reserve like raised its interest rates again more aggressively, in May, mortgage rates increased by less than 20 basis points, and then rates fell to 5.1% like by the end of May. Thus, the data shows that the effect of the Fed's rate hike on mortgage rates was smaller in May than in March. And this is the trend that we see from the last rate hike that we had. So it seems that mortgage rates have already priced in some of the effects of the upcoming like Fed rate hikes. So although mortgage rates will continue to rise, I don't expect to see the same sharp increases that the market experienced back like in March and April. So it's possible rates to surpass like 6% in July and reach about like 6.5% by the year end. And as for prices, which is the other factor that increases like the borrowing cost, we also expect to continue to rise, but at a slower pace. And to give you an idea, home prices will likely rise about like 8% in 2022. So unfortunately, we don't see like in the near future to have some easing the affordability. No, we expect to decline even further.
Yeah, 8% is a lot less than what was 20 to 30% the past year. So
yeah, and we still see like in May we have like 15% price gain. So, but I expect mostly after the summer months, because this is what we need to have in mind. Like seasonality trends are back in the real estate market, so we should also expect after the summer months to have a bigger impact on the rates on the home buying activity.
Mm-hmm. And is the outlook for commercial real estate similar to what we're seeing for residential?
Yeah, although commercial real estate did not experience like the same gains as the residential market in the COVID-19 era, we see that it's getting better. Like, for example, cities return to their pre-COVID-19 states. First of all, about the office leasing activity, areas such as Austin in Texas, Palm Beach in Florida, and Durham in North Carolina are seeing a positive net absorption. However, as we know, real estate is local. That's not the case, for example, for New York City or Los Angeles, in San Francisco, that they still see a negative net absorption since the second quarter of 2020. And then as for rent prices, we see that they have increased at a record pace, while a severe shortage of rent housing has swept the nation. And apartment vacancies hit historic lows as new lease demand increased more than 50%. Also, we see, and finally, online retail sales are still strong, and retail sales excluding online sales are seeing a big recovery. So we are good, but it's not the same as we have in the residential. We see a recovery.
Right, and people are calling this market the Great Deceleration, referring to the slowdown. How would you characterize the current market?
We also mentioned it, but indeed we are seeing, and we expect home buying activity to drop even further, after, especially the summer months. Specifically, we see home sales that have dropped for the last 4 months. However, we don't see the same decrease that we had back in 2007 and 2008. We need to have in mind that this is an acceleration and a return to normalized levels of home activity for the remainder of 2022 and possibly a few years beyond. Small but consistent reductions in home sales activity should be expected. And we also have to have in mind that, for example, 2022, we compare everything with 2021, which was one of the best years. So yes, of course, we want to see, as we mentioned, a healthier market out there with not so many multiple offers. So it's good to go back to normal.
We'll be right back.
We know you love Title Talks, and did you know that PropLogix produces another show for real estate professionals like you? It's called 4 Stories, and it's a weekly show where we share the 4 biggest stories in real estate that help professionals and lay people alike keep a pulse on what's going on in the industry. If you're interested, listen in by visiting proplogix.com/4-stories or searching for 4 Stories by PropLogix wherever you listen to your podcasts.
Title Talks is produced by PropLogix. At PropLogix, we partner with title professionals like you to relieve the pressures of the most repetitive and tedious closing tasks, so you can focus on delivering a better experience to your customers. All you have to do is take those tasks off your list and put them on ours. Now back to our episode.
This is a question that people ask me about, but I tell them I'm not an economist. So, but since I'm talking to an economist, how comfortable are you in making predictions for the housing market over the course of the next 3 to 6 months?
Yeah, no one can tell what it will happen for sure in the next 6 months. However, after looking at the data, we can tell what's more possible to happen. So for the second half of the year, for the third and fourth quarter of 2022, we expect home sales to drop about 14% on average, and home prices to rise about 7% on average. And as for mortgage rates, as I mentioned already, that the 30-year fixed mortgage rate is possible to reach about 6.5% by the year end. So these are some predictions that we have. Of course, this changes sometimes, but now I think it's we have less surprises. So I think it can make our work easier.
Because the situation's so unique in a way, I guess why is it so hard to make those predictions for people who are kind of questioning why?
Yeah, we actually didn't expect, for example, mortgage rates to rise so fast. We expected to have higher mortgage rates, but not at the level that they rose and so quickly. So we had, for example, to revise 2-3 times our forecast. However, the trend was the same. We expected to have higher mortgage rates, but it's the number, it's the estimate that we had to revise it upwards, because we didn't expect to have so fast rising mortgage rates.
Yeah. And so something that we saw at PropLogics as we deal with real estate transactions as well, when prices and rates were low, purchase activity was really intense, right? When prices shot up, but rates were still low, a lot of the industry shifted their focus to refinance business. Is there a pattern that we're seeing here? What kind of comes next for mortgage products?
Yes, indeed, like everybody was trying to benefit from this low mortgage rate. So millions of homeowners refinanced last year in 2021. So that's I think now the issue that we are not going to have like, and we see that refinancing like is slowing down because many of them were able to benefit from lower mortgage rates. So now we don't expect mortgage rates to go like to 3% and below 3% for the upcoming like months and years. So in fact, now what we see also another trend is that we see like more buyers opting for adjustable rate like mortgages for ARMs. And I mean, like rising mortgage rates, like adjustable rate mortgages typically become more attractive to buyers. And this is what we see. Like mortgages have a lower rate than the fixed rate loans, and the savings may be like substantial. Like for instance, like the rate on the 5-year like ARM is still like below 4.5%. That's for the median priced home, the monthly mortgage payment is about like $300 like lower than the payment for a 30-year like fixed mortgage rate. So fixed mortgage. So first-time home buyers may particularly like benefit from ARMs, as like these buyers tend to stay in their homes like for a shorter like period of time compared to other like buyers or other like buyers that they plan to move, for example, in the next 5 or 7 years. They can also benefit from these other like financing products.
As a company, PropLogics, that provides services for title professionals, this makes up a large portion of our audience. And I think that some of them might feel like they have little control over the future of their business. So, like, what would you say to bring their hopes up?
We mentioned that, of course, when we compare with 2021, yeah, we see a slowdown. However, it's like a normal like market. So they will have in mind that normal like performance for their business. So it's not that they're going to lose their business, but when we compare with 2021, of course, we see a slowdown. However, like compared to previous years, it's still like very, very busy. So they should not like be disappointed or discouraged. No.
Yeah, it's going back to normal. So I think that's good for everybody. I think a lot of people prepared for it when it was speeding up, and now that it's slowing down, they're kind of not in shock, but might have happened earlier than they expected, and so they're trying to kind of pivot their business a little bit more.
And still, like mortgage rates are still historically low. So there are like many buyers that are like below 6%. So of course, there are like many opportunities for buyers. So they're like a demand remain relatively like strong. Of course, we see a slowdown in the demand because of the affordability issues, but otherwise, demand is strong. And we know we expect demand to remain strong in the upcoming years due to favorable demographics. For example, for millennials, many of the millennials turning like 30 years old. And we know like homeownership rate, for example, is higher after the age of 33, and it's like about like at 37, it's about like above like 60%. So, and then we have baby boomers with many of them like retiring. So yes, demographics show that, and we should expect that demand will remain relatively strong. So this is good to have like in mind.
Yeah, good point, because it brings me to my next question, which is we saw that you published an outlook for NAR last week, which is the National Association of Realtors, talking about how rates are historically low still, which you just mentioned. Can you talk more about how interest rates shouldn't scare people from entering the market?
Yeah, and this is what we try to put out there. I'm like, of course, mortgage rates are higher than last year, significantly higher. However, when we compare it with the historical average, and specifically for the pre-pandemic historical average, we see that the average historically is about like 8%. And now like mortgage rates are still like below like 6%, 5.7% according to Freddie Mac. So I think buyers need to have this in mind. However, we understand that with more like homes coming to the market, I think will ease some of the issues that buyers face due to the competition, the high competition it's still out there.
Are all these predictions from a geographical perspective consistent? Are there any outliers in the US that you have looked at and saw that there may be a difference in those markets comparatively?
All real estate is local, and we know that. So real estate differs, like varies by area. And some of the areas with strong employment growth, for example, like we have like in Utah and Idaho, like there are some states that they experience, like they have like more jobs now compared to pre-pandemic. We expect like their home buying activity to remain strong. And also in the areas like in the south, like in the Sunbelt areas, we see like many people moving there. So we also expect like stronger home buying activity in these areas, which are like still affordable. And they also like attract like many movers. So in these areas, we may see like still like not to experience like a drop in the home sales, and we may see like higher home price appreciation compared to other areas.
Right. Yeah, that's really interesting to know. And we're local to Florida, so it's it's something that we're seeing here for sure too. Is that
even though the market's Texas as well.
Yes, there are like the places that are like the most popular places for movers. This is where we still see the trend, and we also still see the trend for like movers to relocate to more affordable areas. And Texas and Florida still have like many like affordable areas there.
Yeah.
Mm-hmm.
Well, Nadia, I really appreciate you jumping on this call with me and going through all of these different things going on in the market. I think a lot of people have a lot of questions. I think we answered a lot of them. So thanks for coming on the show. Hope to have you again maybe in the future.
Sure. Yeah. Thank you.
If you haven't already subscribed to 4 Stories, please go find it on whatever platform you listen to Title Talks on, which you should already be subscribed to. If not, you should definitely do that first. Thanks to Nadia and to Jordan for sharing their time to bring us this outlook. Until next time, happy closings.